March 21, 2002. A hearing room of the House Energy and Commerce Subcommittee on Oversight and Investigations. Roy Olofson, formerly Vice President of Finance at Global Crossing Limited, takes his seat at the witness table. Behind him, subcommittee staff have mounted an enlargement of a single internal communication referring to a category of transactions the company had been booking as revenue, characterizing them as a pure swap with no economic substance. The company had filed for Chapter 11 protection 7 weeks earlier, on January 28, 2002. At the time of filing, it was the fourth largest bankruptcy in United States history. The question the subcommittee had convened to address was not whether Global Crossing had failed. The failure was on the public record. The question was how a company that had reported approximately $3.2 billion in revenue for the first 3 quarters of 2001 had been generating much of that revenue by selling capacity on its fiber optic network to counterparties who were, in the same accounting periods, selling equivalent capacity back. This episode examines the mechanism. The instrument was the Indefeasible Right of Use. The accounting treatment was upfront revenue recognition. The structural device was the concurrent swap. To understand what Global Crossing did, the listener must first understand what an indefeasible right of use is and what it was designed to do legitimately. An indefeasible right of use, known throughout the telecommunications industry as an IRU, is a long-term contractual right to use a specified amount of capacity on a fiber optic cable or network. It is not ownership of the fiber itself. It is the right to transmit a defined quantity of data on a defined route for a defined term, typically 20 to 25 years. The right is indefeasible in the sense that the grantor cannot revoke it during the term, subject to the contractual conditions. The IRU emerged as a standard instrument in submarine cable consortia in the 1980s and 1990s. Building a transoceanic cable required capital expenditures that no single carrier could justify on the basis of its own traffic. The consortium model allowed multiple carriers to fund construction collectively, with each receiving an IRU for its share of the completed capacity. The structure was legitimate, well understood, and economically rational. It allowed carriers to acquire capacity on routes they could not afford to build alone. In the late 1990s, as competitive long-haul fiber networks proliferated in the United States and across the Atlantic, the IRU evolved from a consortium funding instrument into a wholesale capacity product. Carriers that had built networks faster than they could fill them sold IRUs to carriers that needed capacity on routes those carriers had not built. The transaction made commercial sense. One carrier had supply, another had demand. The IRU transferred the right to use capacity for a period of years in exchange for a payment, typically made largely upfront. The accounting treatment for the seller of an IRU under United States generally accepted accounting principles as applied in this period depended on the structure of the transaction. If the IRU met the criteria for treatment as a sales-type lease or as a sale of a specific identifiable asset, the seller could recognize the full contract value as revenue at the point of delivery, rather than ratably over the 20-year term. The criteria included, among other things, that the buyer obtain specific identified fibers or wavelengths, that the right be exclusive, and that the transaction transfer the substantive risks and benefits of ownership of the capacity. The accounting treatment for the buyer of an IRU was different. The buyer treated the IRU as a capital asset. The expenditure was capitalized on the balance sheet and depreciated over the useful life of the asset, typically the term of the IRU. The buyer did not recognize the full purchase price as an expense in the year of the transaction. The buyer recognized a small portion as depreciation expense each year. This asymmetry is the structural feature that the mechanism exploited. Consider what the asymmetry permits when two carriers enter into reciprocal IRU transactions in the same accounting period. Carrier A sells an IRU to Carrier B for $100 million. Carrier A recognizes $100 million in revenue in the current quarter. Carrier B capitalizes the $100 million as a long-term asset and depreciates it over 20 years, recording a depreciation expense of approximately $5 million in the current year, or roughly $1.25 million in the current quarter. Now reverse the transaction. Carrier B sells an IRU to Carrier A for $100 million. Carrier B recognizes $100 million in revenue. Carrier A capitalizes the $100 million and depreciates it over 20 years. The net cash flow between the two carriers, if the payments offset, is zero. The net economic transfer of capacity, if the IRUs are on routes neither carrier needed, is functionally zero. But the income statement effects are not zero. Both carriers have added $100 million to current period revenue. Both have added approximately $1.25 million to current period depreciation expense. The current period earnings impact is positive by approximately $98 million on each side. This is the architecture of the concurrent IRU swap. The Securities and Exchange Commission, in its subsequent enforcement findings, characterized these transactions as lacking economic substance. The internal communication enlarged behind Roy Olofson at the March 2002 hearing used the same characterization. The record establishes how Global Crossing deployed this mechanism over the course of fiscal year 2001. Global Crossing had been founded in 1997 to build a global fiber optic network. By 2000, it had completed or substantially completed the Atlantic Crossing Cable, the Pacific Crossing Cable, and a continental backbone network in the United States and Europe. The capital expenditure required to build this network was financed through a combination of equity issuances, high-yield debt, and bank credit facilities. By the end of 2000, the company carried approximately $7.6 billion in long-term debt, according to its annual report on Form 10-K filed with the Commission. Servicing this debt required revenue. The business plan presented to investors and to lenders had projected revenue growth based on the sale of capacity to enterprise customers, internet service providers, and other carriers. The actual market for capacity in 2001 deteriorated faster than the business plan had anticipated. The proliferation of competing networks during the build-out period had produced an oversupply. Prices for capacity on most major routes were declining at rates of approximately 50% per year on a per-bit basis, according to industry analyses cited in the subsequent bankruptcy examiners' reports. In this environment, Global Crossing entered into a series of IRU swap transactions with other carriers, primarily in the second, third, and fourth quarters of 2000, and continuing through 2001. The principal counterparties identified in the public record included Qwest Communications, 360 Networks, and several other carriers operating long-haul fiber networks. The Securities and Exchange Commission's subsequent administrative findings, which Global Crossing settled without admitting or denying, established the following structural features. Step 1. The transactions were typically negotiated as paired contracts. Global Crossing would agree to sell an IRU to the counterparty on certain network segments. The counterparty would agree to sell an IRU to Global Crossing on certain network segments. The contracts were often signed at or near the same time, in some cases on the same day. Step 2. The contract values on each side were substantially equivalent. Where there were differences, they were typically modest relative to the gross transaction values. The net cash flow between the parties, in many cases, was small in relation to the gross revenue each party recognized. Step 3. The IRU's Global Crossing acquired in these transactions were, in significant part, on routes where Global Crossing already had capacity that was not being utilized. The record establishes that the company's own network had substantial unused capacity throughout this period. The acquisition of additional capacity on overlapping or parallel routes did not address an operational need that the company's existing network could not have met. Step 4. The IRU's Global Crossing sold were recognized as revenue up front under the sales type lease or similar accounting treatments. The IRU's Global Crossing purchased were capitalized as assets and depreciated over 20 years. Step 5. The aggregate effect on reported financial performance was material. The bankruptcy examiner's subsequent analysis and the Commission's enforcement findings established that a substantial portion of the revenue Global Crossing reported in 2001 derived from transactions of this structural type. The exact percentage varies depending on the methodology and the inclusion criteria, but the public record establishes that the magnitude was sufficient that, without these transactions, the company's reported revenue growth would have been materially lower or negative. The structural question is not whether each individual IRU contract met the technical accounting criteria for upfront revenue recognition. Several of them did, on the face of the contract terms. The structural question is whether the transactions, taken together as paired exchanges, represented genuine sales of capacity to third parties or constituted, in substance, exchanges of equivalent assets between parties who would not otherwise have transacted. This is the point at which to introduce the internal communication referenced at the March 2002 hearing. Roy Olofson, the former Vice President of Finance, had written a letter dated August 6, 2001 to James Gorton, the General Counsel of Global Crossing. The letter raised concerns about the accounting treatment of certain capacity transactions. The letter was subsequently produced in the bankruptcy proceedings and to congressional investigators. In substance, the letter identified specific transactions and questioned whether the upfront revenue recognition was appropriate given the absence of economic substance on a net basis. The characterization "pure swap with no economic substance" that appeared on the easel at the hearing was drawn from contemporaneous internal communications produced in the same process. The record establishes that personnel within the company's finance organization had identified the structural pattern and articulated it in those terms before the public exposure of the practice. What happened to the Olofson letter internally is a matter the subsequent investigations addressed. The company's own internal investigation and the Commission's findings established the timeline and the responses. The letter did not result in a restatement of revenue at the time it was submitted. The transactions continued. The company filed for bankruptcy approximately 5.5 months after the date of the letter. To complete the architectural picture, it is necessary to identify the counterparty side of these transactions. The structural device was not unique to Global Crossing. The Commission brought enforcement actions against other carriers for substantially similar transactions during the same period. Qwest Communications International entered into a Commission consent order in October 2004 addressing, among other matters, IRU and capacity swap transactions during 2000 and 2001. The Commission's findings established that Qwest had improperly recognized revenue on transactions that lacked the characteristics of genuine sales to third parties. Qwest restated its financial statements for the relevant periods. The restatement removed substantial amounts of previously recognized revenue. The settlement included monetary penalties and disgorgement. 360 Networks, a Canadian-headquartered fibre carrier, filed for bankruptcy protection in June 2001 before Global Crossing. The bankruptcy proceedings produced documentation of the IRU swap structure that overlapped with the documentation later produced in the Global Crossing proceedings. The point of identifying these counterparties is not to assign relative culpability. The point is structural. The IRU swap mechanism required two willing parties on each transaction. The mechanism propagated across the industry because the same incentive structure that drove Global Crossing to seek revenue through these exchanges drove other carriers to participate. Each carrier needed to demonstrate revenue growth to investors and lenders. Each carrier had built more capacity than the market would absorb at sustainable prices. The IRU swap permitted each carrier to convert excess capacity into reported revenue without requiring the existence of an end customer. The detection failure must be examined at multiple layers of the verification chain. The structural question is what would have had to be true at each layer for the practice to have been identified earlier. The first layer is the company's external auditor. Global Crossing's auditor during the relevant period was Arthur Andersen LLP. The accounting treatment of IRU transactions was an area of professional attention during this period. The American Institute of Certified Public Accountants and the Financial Accounting Standards Board's Emerging Issues Task Force addressed aspects of capacity contract accounting in technical publications. The applicable guidance permitted upfront revenue recognition where specific criteria were met. The criteria were oriented to the individual contract. What the criteria did not require in the form then in effect was an evaluation of paired transactions as a single economic arrangement. If Carrier A sold an IRU to Carrier B and Carrier B sold an IRU to Carrier A, the accounting standards applicable to each contract evaluated each contract on its own terms. The doctrine that paired transactions lacking economic substance should be treated as exchanges rather than as sales existed in the broader body of accounting literature, particularly under guidance addressing non-monetary exchanges. But the application of that doctrine to IRU transactions was a matter of judgment, and the doctrine had not been codified in a manner that compelled a uniform treatment. The Commission, in its subsequent enforcement actions and in subsequent rulemaking, addressed this gap. Staff Accounting Bulletin No. 1, issued in December 1999, and subsequent guidance tightened the criteria for revenue recognition. The Emerging Issues Task Force Issue No. 018, addressing whether an arrangement contained a lease, and subsequent guidance specifically addressing capacity contracts refined the treatment. The guidance that ultimately emerged was more restrictive than the guidance in effect during the period of the IRU swap practice. The second layer of the verification chain is the equity research analysts and credit rating agencies. The company's financial statements during the relevant period disclosed the existence of IRU sales and capacity sales in general terms. The financial statements did not, in the disclosures of the time, provide a counterparty by counterparty breakdown that would have permitted an external analyst to identify the paired structure. The disclosures aggregated revenue by category. The categories did not isolate transactions with reciprocal purchases. An analyst seeking to identify the paired structure would have needed to compare Global Crossing's reported transactions against the reported transactions of each potential counterparty, identify pairings by approximate timing and magnitude, and infer the swap structure from external data. This analysis was not impossible. It was performed in part by certain short sellers and by some financial journalists during 2001. But the inference was not conclusive on the basis of public disclosures alone, and the companies themselves did not provide the disaggregation that would have made the inference straightforward. The third layer is internal. The Olofson letter establishes that the structural pattern was visible to personnel within the company's own finance organization. The question why internal escalation did not result in earlier disclosure is addressed in the company's internal investigation report, which was produced to the bankruptcy court and to congressional investigators. The substance of that report is on the public record. The record shows that the internal handling of the Olofson concerns did not produce a restatement during the period in which the company remained a going concern. The fourth layer is the regulator. The Commission's review of periodic filings is a sampling exercise constrained by resource limitations. The Commission does not, as a matter of routine practice, audit the underlying transactions of every registrant. The Commission's enforcement actions against multiple carriers for capacity swap transactions established that the practice was identified and addressed once the underlying facts came to light through bankruptcy proceedings, whistleblower communications, and journalistic reporting. The earlier identification of the practice would have required either a more granular disclosure regime or a more intensive transactional review. What would have had to be true for earlier detection? At the auditor level, the accounting standards would have had to require treatment of paired transactions as a unitary arrangement. At the analyst and rating agency level, the disclosure standards would have had to require counterparty-level reporting of capacity transactions sufficient to identify reciprocal pairings. At the internal level, the channels for escalation of accounting concerns would have had to produce action before public exposure. At the regulator level, the review process would have had to include transactional sampling of revenue recognition in industries where the structural risk was elevated. Each of these conditions was, in some measure, addressed in the regulatory and standard-setting response that followed. The unravelling sequence is established by the public record with reasonable precision. In May 2001, 360 Networks, one of the principal counterparties to Global Crossing's IRU swap transactions, defaulted on its debt and announced that it would seek bankruptcy protection. The 360 Networks bankruptcy filing followed in June 2001. The bankruptcy proceedings of a major counterparty exposed transaction documentation to public view that had not previously been accessible to external analysts. In the summer of 2001, financial journalists and short sellers intensified their analysis of Global Crossing's reported revenue. Articles in the business press during August and September of 2001 raised questions about the composition of the company's revenue growth. The share price, which had reached a peak of approximately $64 in 1999, declined through 2001 to single digits by the fourth quarter. The Olofson letter, dated August 6, 2001, was submitted internally. The subsequent handling of the letter, as documented in the company's internal investigation, did not result in public disclosure during 2001. In the fourth quarter of 2001, the company's liquidity position deteriorated. The capacity market had not recovered. The company's ability to service its debt from operating cash flow was no longer credible to its lenders or to the credit rating agencies. Standard & Poor's and Moody's downgraded the company's debt ratings during this period. On January 28, 2002, Global Crossing Limited and certain of its subsidiaries filed voluntary petitions for relief under Chapter 11 of the United States Bankruptcy Code in the Southern District of New York. The filing listed approximately $22.4 billion in assets and approximately $12.4 billion in debts, based on the schedules filed with the petition. The filing was, at the time, among the largest bankruptcies in United States history. Within days of the bankruptcy filing, the Olofson letter became public. The Securities and Exchange Commission and the Federal Bureau of Investigation opened investigations. The House Energy and Commerce Subcommittee on Oversight and Investigations announced hearings, which were held in March 2002, at which Roy Olofson testified. The Commission's investigation proceeded over the following 2 years. The Commission issued formal orders of investigation, took testimony, and reviewed documents. The Commission's enforcement action against Global Crossing was settled by administrative consent order. The order, which the company resolved without admitting or denying the findings, established that the company had engaged in transactions that did not have the economic characteristics necessary to support the revenue recognition treatment applied to them. The Department of Justice declined to bring criminal charges against the company's senior executives. The declination, announced in December 2004, concluded the criminal investigation of the IRU swap practice without indictments of the company's most senior officers. The department's decision was based on its assessment of the evidence against the standard required for criminal prosecution, which differs from the standard applicable in civil enforcement. In civil litigation, the company's bankruptcy estate, securities class action plaintiffs, and other parties pursued recovery. The securities class action against the company's directors, officers, and underwriters was settled for approximately $245 million, according to the public record of the settlement approval. The settlement did not include admissions of liability. The company emerged from Chapter 11 protection in December 2003, having sold a controlling interest to Singapore Technologies Telemedia. The reorganized company continued to operate the network. The reorganized company was subsequently acquired by Level 3 Communications in 2011. The physical fiber network built during the 1990s build-out continued to carry traffic. The capacity that the IRU swaps had nominally transferred remained, in operational terms, the same capacity it had always been. The structural findings established by this case are as follows. First, the IRU swap as a revenue generation mechanism operated through the asymmetry between revenue recognition by the seller and asset capitalization by the buyer. The mechanism required only that the contract terms on each side satisfy the technical criteria for the respective treatments. It did not require that the paired transactions, considered as a unitary arrangement, transfer economic value between the parties on a net basis. Second, the propagation of the mechanism across multiple carriers in the same industry during the same period indicates that the structural conditions, not the conduct of any individual firm, drove its adoption. The conditions were an industry with substantial overcapacity, a debt-financed capital structure requiring continued revenue growth, an accounting framework that evaluated contracts individually, and a disclosure framework that aggregated revenue without counterparty detail. Where these conditions are present, the structural incentive to construct reciprocal transactions exists independently of the disposition of any particular firm. Third, the regulatory and standard-setting response addressed each layer of the verification chain. The Financial Accounting Standards Board and the Emerging Issues Task Force refined the guidance applicable to capacity contracts and to revenue recognition more broadly. The codification of revenue recognition standards under accounting standards. Codification Topic 606, effective for public companies in 2018, established a more comprehensive framework for evaluating whether revenue should be recognized, when, and in what amount. The framework includes explicit consideration of whether a transaction has commercial substance. Fourth, the Sarbanes-Oxley Act of 2002, which Congress enacted in the months following the Global Crossing bankruptcy and the substantially contemporaneous WorldCom and Enron failures, established requirements for internal control over financial reporting, executive certification of financial statements, and protections for internal whistleblowers. The Olofson letter and similar internal communications produced in other corporate failures of the period contributed to the structural design of the whistleblower protections in Section 806 of the Act. Fifth, the case establishes the limits of disclosure-based investor protection in industries where the structural risk is concentrated in transaction patterns rather than in individual line items. Investor protection through disclosure requires that the disclosures provide the information necessary to identify the relevant pattern. Where the pattern is constituted by paired transactions with counterparties, and the disclosures aggregate transactions without counterparty identification, the disclosure regime does not produce detection. The forensic finding is that the IRU swap mechanism was not concealed by misstatement of individual transactions. Each transaction, in its individual contract form, was a real contract for the transfer of capacity rights. The mechanism was concealed by the structural feature that the pairing of transactions was not required to be disclosed in a form that would permit external identification. The detection of the practice required either internal disclosure, as occurred through the Olofson letter and analogous communications at other firms, or the exposure of counterparty documentation through bankruptcy proceedings, as occurred with 360 networks. The case is closed. The findings are on the record. The mechanism is documented.